Well, thanks very much for joining us. This morning's topic is the 5 myths of customer service satisfaction, what customers really want to be satisfied from your financial services institution. My name is Mike Clarkin. I'm the Vice President of Marketing at Sykes Enterprises. Sykes is a global contact center outsourcer with 35,000 people, and 7 of the top 10 institutions in the United States are our clients. And part of our responsibility, part of our contribution today is that we've spent the last 5 years really working with our clients to redesign customer experiences to make them more effective and make their customers more loyal. And through that process, we've learned a lot about what does and doesn't work in terms of making loyalty happen and making customers satisfied. And I've got today with me Jim Eckenrode.
Thanks, Mike. Playing the role of Nicole Sturgill in your program today, Jim Eckenrode, Banking Research Executive at TowerGroup. TowerGroup is an industry research firm focused on the intersection of business and technology. I've been with the company about 13 years, 25 years in the banking industry, and advise clients on business technology strategy and alignment, product development, marketing, and banking industry trends and directions. So I think what we're going to do today is spend a few minutes sort of setting up the problem of customer experience and what it means in the environment today. And then Mike and I are going to have a little dialogue around the research that Sykes has done, looking at the conventional wisdom of a positive customer experience. And I think you're going to be interested to see how we're going to debunk some of those myths. So without further ado, I'm just going to step up to the podium here, and hopefully you can still hear me. Just to briefly set the stage, obviously we're in an environment right now where there's a lot of turmoil. We all know that. And at the center of all this turmoil is customer perceptions about their relationship with their bank and the experience that they have with their financial institution. So I'm just going to spend a couple of minutes talking about the disconnect, the nature of the disconnect, what it actually looks like, to sort of set up the problem. And really, I think what you have to do is you have to look at what we have defined at TowerGroup as the the retail banking customer hierarchy of needs. And this is based on some research that we have done over the past year, surveying customers across the world, various geographies. And as you'll see, I'm going to focus on 4 major countries in sharing some of these results. But I think as we looked at the data, what you find is some very consistent attributes about what customers expect from their banks and what they need from their financial institutions. First and foremost is trust. Okay? No secret, obviously. We need to trust that the bank is taking care of my data and that the bank is solid and sound and is going to be there and manage their own balance sheet properly. Can I trust you to protect me and my money? The bank's aspiration there is really robust security and risk management, financial risk, data risk, all of that. Moving on, value. Do I get value from my relationship? Are the fees fair? Are they equitable? Am I getting a return on my investment? And I think the value proposition for banks needs to change from punitive fees toward fees for value. Moving up from the most fundamental issues to maybe higher order issues, simplicity. Are you easy to do business with? And there the aspiration has to be flawless execution. Products that meet my needs and are a fit for what I expect and where I'm going is next in the hierarchy, and the aspiration there for a bank is differentiated products. And then finally, advice. Can I get quality advice and guidance? So these are the hierarchy of needs as uncovered by the research that we've done. Unfortunately, other surveys that we've done look at retail bank executive priorities. And what we find is that around the world, retail bank executives right now report that their major challenges have to do, no surprise, with revenue enhancement, growing the loan book, growing deposits, building fee revenue, et cetera, et cetera. Very little focus on retention, very much at the bottom. And I would argue that right now, retention is a major issue, okay? The challenges that they're facing are shown on the left-hand side of the chart that you're looking at. Number 1, ensuring consistent execution. And what we find, this is a bit of an eye chart, so you'll have to forgive me, but what you find when you dig underneath what customers are reporting about their experiences is that across 4 major geographies, Australia, Canada, the UK, and the US, very consistent levels of dissatisfaction around things like policies that limit the employee's ability to solve my problem, no clear accountabilities and means to contact the bank, lack of a first call resolution. These are major issues that I think get in the way of the bank's ability to grow, and it's a fundamental problem that we need to solve. How does that play out in terms of revenue? Well, all you have to do is look at the way that customers are viewing their financial institutions. They lack confidence in the bank's integrity and values. They're not willing to recommend their bank to their friends and family, and they're not likely to buy in the next 6 to 12 months. These are the people that experience bad service, and obviously it hits the bottom line. While we're so focused on self-service, the reality is that customers that we survey suggest that by and large, they still want to deal with their bank in a face-to-face or person-to-person context when dealing with problems and issues. 31% of respondents that we surveyed suggested that phone was the primary avenue for solving problems, and then in-person staff and management. So really, it still is a people-to-people business in many respects. So with that as sort of the problem that we set up, what I'd like to do now is talk about customer experience, how you change the needle in terms of that level of customer dissatisfaction, and what Mike and his team have found in some of the research they've been doing at Sykes around the 5 myths associated with customer service and satisfaction. Okay, so Mike and I are going to have a little dialogue, and then obviously we're going to open it up to questions. So here are the 5 myths, and we're going to go through each of these in turn. What you see at the top is the myth, and what you see at the bottom is the reality of the situation. So let's deal with number 1 first, which is the squeaky wheel gets the grease. How do you deal with customer dissatisfaction? Well, the myth is that you deal with the people that are most dissatisfied. Mike, what's the reality?
Well, I think in this room and most clients that we work with, the first reaction to an initiative to improve customer experience is to go solve the complaints. You go try and eliminate people who are saying or feeling bad about their experience with your brand. And it's an automatic reaction, I think, because of the power a complaint has inside of a company.
Yep.
But I think the net conclusion we've come to is that that's a good thing to do to a limit, and then you have to stop and try and work on something else, because in general, complainers or people who are really unhappy represent less than 10% of all interactions.
Right.
So it has a tendency to draw a lot of resources, a lot of initiative, but can really only impact a tiny percentage of really changing the needle on your customer satisfaction.
So you're spending a lot of resource to deal with a very small segment of the population, right?
Right.
So I think you've got some data that talks about that a little bit.
Well, and this is just a client example in the card services space who definitely had an issue with dissatisfaction being about 12%. But when we really looked at it, that 12% was probably not easily addressable without changing fundamental policies and practices. This was people complaining about fees and reps that had no authority to change them. So when we really dug into it, the bigger opportunity when we looked at the chart was, geez, there's 70% in the middle, and just simple improvements in agent soft skills and representative interacting with the customer allowed for a 10% improvement, and you couldn't possibly get that out of the dissatisfied customers and making them more happy.
But isn't it also true that some of those, in this example, 12% of customers that are dissatisfied or very dissatisfied are really important customers for you? Are you saying that we just ignore that segment altogether?
No, I think there's a right level of emphasis there, and 2 things you can do in the bottom areas that are important. One is to pick out the most important clients and make sure they're getting service in the right channels, your high-value clients, and the other is when you see systemic issues, to solve them. But I think what you'll also see is that at least half of this stuff in the bottom is exceptional cases, unusual, odd failures, and those aren't really easy to address systemically no matter what you do.
Right, okay. Let's move on to myth number 2, which is the agent is the experience. In other words, soft skills, right? Dealing with the agent, having the agent make sure that not only do they know process, but that they have all the soft skills to help customers with their issues. And I think you found something different.
Well, what I'll say here is that the human interaction is really important, but can't make up for more fundamental issues that might be at hand. And so if you have a process or a policy that prevents a customer from being happy, no amount of human skills or empathy is going to make that get better or make that customer really happy.
Right.
And so the tendency in there is to believe that, work on the thing I have in front of me. I've got a call center full of people, or I've got a branch full of staff, and if I just work on their soft skills and their human skills, that I can create really good customer experiences, but they cannot make up for, hard skills, I'll call process or policy issues. In one client example, an insurance company, they spent 3 years trying to make customer experience numbers go up. by working on agent skills. And what they really found was that if they just made a really good commitment that you're going to get your check cut in 2 weeks' time and it showed up in 2 weeks' time, customer satisfaction was really high. If they missed that by a week, satisfaction was low. And then really the agent was just on the margins of sort of impacting that. So processes were more important than human skills in that case.
And I think customers are able to discern that. That's backed up by some of the research that we found that, there is a lot of frustration around process inefficiencies. Let's move on to number 3, which is, I think, a really interesting one, and that is that resolution equals satisfaction. Some of the research that I showed you a minute ago said that there's frustration in the part of the customers with a lack of first call resolution. I think you've got a different point of view on that.
Well, just a question, does anybody in the room have a first call resolution metric somewhere in their operation? I mean, we see them everywhere, and in fact what we see a lot of the cases is that clients have said, satisfaction is hard to measure, resolution is easier, I'll substitute resolution for my primary metric.
Right.
But what really has struck us is that on the surface it's true, right? So if I take data from a recent project we did, it's true, the more satisfied customers were more likely to have had their case resolved. But satisfaction is a yes or no question. So when I flip it and say, if you were resolved, how satisfied were you? Now you see that satisfaction doesn't actually resolution doesn't cause satisfaction. It's one of the things you have to get through. It's a gatekeeper metric. It's something you have to accomplish. It's a qualifier, but it doesn't really finish the job. There's more things to be done on top of that to really get to customer experience. It's high.
So it's interesting because some other research that we've done suggests that the loyalty effect is there's a definite the needle is definitely able to be moved based on first call resolution.
Sure.
Right. Our statistics show that loyalty scores increase by an average of 75% if you're able to effect a first call resolution. And in fact, if you're not, if you give the customer the runaround, that loyalty effect erodes by several 100%. So there is something to this.
It's a powerful impact. Well, I think it's a lack of resolution can cause real dissatisfaction, but the presence of resolution now gets you kind of to neutral, and then you have opportunities to add on top of that. So that combined with other factors can make what I call the loyal experience, but by itself it's not sufficient to be the winner.
Okay.
All right.
Let's go to the next one. More time equals better experience. If you're spending time with your customer, face to face or in the call center, that's going to necessarily result in a better customer experience.
It's an interesting thing. I find there's 2 schools of thought on this. There are some companies that say, I want to be generous with my time and feel like clients will respond with a loyalty effect. And others will say, I can't afford to spend any more time, it's money, so I'm going to sort of feel like I'm limited. But what we really find is that no matter how much time you give, the more time you give, the more you just create room for inefficiencies, right? And so back to this kind of resolution question, in certain programs where resolution is most important, and they give the rep a lot of flexibility to take as much time as it takes to solve a problem, they'll try to solve problems they're not really able to solve, period, right? That they have a low likelihood of finishing that should be handed off to somebody else. And so in a spirit of trying to be focused on resolution, getting it one and done, they'll spend 2 or 3 times as long on a call or with a customer that they need to, that could have been better done someplace else. So what we find is that giving more time to your staff rarely creates better customer experiences. It just takes some of the pressure off of being efficient. It's an operational thing, and I think it's a balance thing.
Right, exactly. All right, let's go to number 5. I think this is really an interesting one. Satisfaction causes loyalty. I think a lot of folks in the industry and probably across industries will commingle, if not confuse, the issues of satisfaction or the metrics around satisfaction with true loyalty. And again, that's the myth. What's the reality?
Well, I think the reality is that, first of all, what we're learning is that satisfaction is an attitude or an opinion. How satisfied were you today? Whereas loyalty is a set of behaviors. What constitutes loyalty in your business? Do you want them to buy one more product? Do you want them to stay with you 2 more years? Loyalty is a behavior or an action somehow that's a response to their attitude. And so, again, 95% of the clients that I work with, their primary satisfaction metric happens to be top 2 box customer satisfaction, right? But there's a lot of room in the top 2 boxes to differentiate between satisfaction that creates real loyal experiences and satisfaction which just creates kind of passive happiness, right? And so I think about a card client of ours who this year said, we have 85% but it's 35% in the top box and 50 in the second. We want to flip that and make it 50 in the top box, realizing that that top experience is far more likely to create a willingness to recommend or buy a second product or a fifth product, or just stay around for 4 more years in the experience. And so they're realizing that while top 2 boxes is a nice general metric, it doesn't really prove out very well in terms of predicting value to the institution.
Do you have specific metrics that you look at that are really associated with loyalty as opposed to satisfaction?
We like to see a couple loyalty metrics. I think some are, you can ask the how willing are you to recommend metric. You can ask how many products do you own, or would you buy another product, or do you intend to buy again? I think it depends on what your business goal is and what you think loyalty looks like for you.
Okay.
If you're focused primarily on retention, then ask the question, will you renew, or will you re-up, or will you, extend with us?
Right.
If your primary metric is, geez, I want you to own 5 products, then, would you consider, or have you bought, or, would you buy another product from us? I think is a far more powerful question to ask than just how satisfied were you today with this kind of one moment in time.
I think the dynamic that you talked about in terms of behavior and attitude is interesting. We ran across this company called Walker Information Services that looks at this in somewhat of a similar way. And they've created a 4-box model that looks at positive and negative behavior and positive and negative attitude. And if you just look at the intersection, right, you start to think about not only the behavioral behavioral aspects of your customers, but it also suggests what you need to do to grow that business, right? So let's take an example. You've got a customer whose attitude is positive. They like you. They may be satisfied with what you do, and in some cases they may even be loyal to you, however you define that. But their behavior is actually negative. They haven't bought more than 1 product with you, right? So what do we do there? We really focus on trying to find the right product to grow that relationship. On the other side, you may have customers whose behavior is positive. They bought a lot with you, but their loyalty or their satisfaction or their attitude is negative. These customers are trapped, right? And it's a little bit turning what you just talked about on its head, right? The trapped customer is the one that really we need to focus in a different area.
Right.
And Walker will tell you that over 50% of the customers of a bank are in that category. So again, this sort of reflects back on your thinking about it's that middle that you really need to focus on.
Yeah, I think looking at this chart, most of the programs that we look at look more like the one on the left than the one on the right. I think there's way more opportunity to sort of get people to be advocates and to take behavior, and you're right. The trigger for moving that can be interesting.
Yeah. So pull it all together, and then I have a couple of other questions for you.
Sure. Well, so I think what you're hearing me say is, the conventional wisdom potentially can be a trap that you can fall into. And so all we're really saying is that all these metrics are good in some sort of balance, but they're not necessarily good individually by themselves. And so our 3-step approach here is, first of all, let's be clear about what business goal you're trying to accomplish. If you're trying to stop churn, or you're trying to encourage word of mouth, or you're trying to increase wallet share, once you've identified clearly what your business objective is, now you can pick the metric you want to use. It's the behavior you're trying to stimulate. So then measure that, but then look sort of based on what we talked about today, realize that then when you look at your portfolio of customer experiences and say some are really poor, some are kind of in the middle, and some are really great, each one of those requires a different strategy to be effective, and no one strategy or no one metric is going to allow you to make all those things get better at the same time.
Right.
So it requires a balanced approach, I call it a 5-box strategy. This says I have to have 5 strategies to make it happen, so you don't sort of fall into that myth of saying one of these things is going to make it all good for me, or that's going to be my initiative for the year.
Okay. All right. All interesting stuff. So I'm a banker, I'm sitting in the audience. What do I do now?
Well, I think the first question is, as we heard yesterday, is first say, where am I today? So look at your institution, look at how you're managing customer experience today, and say, what are the metrics that drive my behavior most today? It's a question I ask every client. What's the one metric if I fail at, you're going to beat me up about, right? And that'll tell you kind of where your weight is. Are you more focused on dissatisfied customers? Or are you more focused on that top 2 box score? Which one is it that kind of anchors you today? And then say, okay, given that, how do I then pick 1 or 2 new strategies to add to that to balance it out? Right?
Yep.
I think what you heard me here to say today, the biggest miss in most companies I see is this huge opportunity in the middle to sort of take your middle experienced customers, your middle performing people, and say, how do you move them up just a half a step? It can make a huge impact on your scores no matter what your metric happens to be.
And The challenge I think that you have in affecting those sorts of outcomes is understanding of what your customer base actually looks like. Right? How big of a problem is that in terms of a precursor to starting down the road with some of these ideas?
Well, I think truly understanding your customer is a lifelong project.
Yeah.
But I'll tell you that there are pragmatic things you can do, and in my business where we work in call centers, it's amazing how powerful listening to 50 phone calls can be.
Yep.
And you come away saying, geez, I got 4 different kinds of callers that come in, and each one of them need this different kind of experience, and I want to fix that one this month because that's the one that's truly being sub-optimized and not delivering the way it should be.
Yep.
And so it's not as hard as it might look, and it's pretty tangible to go act on right away.
All right, I'm going to go off the script here for a minute. So,
yep, that's fine.
I led a workshop yesterday in which we talked about the changing nature of the customer, the changing nature of delivery channels in retail banking, and the changing nature of infrastructure. And what we're seeing in the industry right now is that we're still talking about a lot of the same challenges we've always talked about. The role of the branch, how to integrate channels together, how to market more effectively to customers, what do we do with all of our outdated infrastructure, stuff that we've been talking about for years and years and years. But underlying that, I thought were some interesting philosophies or orientations that came out of the dialogue, one of which is that we're becoming a technology business, whether we like it or not. Our customers are taking us there, and the types of people that we put in customer-facing roles have to be as familiar with technology as they are with the bank's rules and processes and rates and prices. Not to say that we all need to go out and get a computer science degree, but that so much of what we do has to do with technology. The other side of it is that there was a really interesting discussion around the concept of focusing on particular customer segments. And it's no secret that a lot of banks right now are looking at their customer base and trying to figure out which customers do I really want to go after? How do I retain the ones that I really want? And as one person put it, one banker in the audience, how do I fire the customers I don't want anymore? Right? How does that play out in terms of the contexts that we're talking about here in terms of loyalty and satisfaction and achieving objectives?
You know, it's interesting. It does play out, and I think it's powerful for a representative to have some knowledge of who a customer is and kind of how you define them. But what we're finding is that I'll call also situational segments, right? So I call in, I take an example recently of a corporate card client of ours where we listen to their clients call in, and a quarter of the time, the caller's in an urgent situation. My card's been blocked. I'm checking out at the hotel. Help me out, right? A fraud flag got popped up someplace. That situational experience, it's a segment in time, says I need to have a quick, urgent, empathetic conversation, and I need to get this done so he can get checked out, right? Another quarter of the time was I just want to activate my card. Now I need a simple step-by-step, follow the rules kind of process. It's more transactional. It's less. I don't need the personal, empathetic, comforting, what'd you think about the football game kind of conversation. So even in those situations, you can segment people based on behavior and react to them based on their mode of sort of them indicating to you what kind of communication experience do I want to have that'll match up with me. And I don't have to know that they're a high-value client or underserved or what have you, because for me it doesn't really impact the kind of experience they want right now, but it impacts is the problem they have today.
What about the technology angle? I mean, we've seen the evolution of the contact center agent role towards specialization by product or by business line. Some banks that I'm talking to now are looking at the way they communicate with clients as an integrated strategy across various modalities, right? Text, email, Twitter, voice, video, all of that, right? And they're trying to think about the way they communicate with their customers, both inbound and outbound, in a very integrated way across all of those platforms. How does that change what we're talking about here, if at all?
Well, I think a couple of things. One is, in general, the rep role is getting more sophisticated as time goes by.
Right.
As you shift more and more to self-service and alternative channels, what's left over, the phone calls that come in, are either more complicated or more sensitive somehow. I think second, and you kind of come at this, why do people care about first call resolution? The drive towards specialization means it's really more likely you'll land with a person who can't solve your problem because they're not trained to do so.
Right.
And so you hear a lot of talk about universalizing agents, but you think about the training and education that has to go into that, or the caliber of person you have to make that effective. I think, to answer your question, the reps today have to be more aware of the channels available and sort of where the best potential solution is. Right? I have to accept as an associate that I might not be able to solve your problem, but if I can get you to the right place quickly, you'll appreciate that speediness to resolution because I got you the right owner. It might have been online for that matter. Than me trying to sort of own everything and finish everything. I think that's expecting too much of humans in general, right? As things get more complicated, putting more of that burden on the front line is tough.
Yeah, it is, and that's both a hiring issue and a training issue. We're just about out of time, but I want to give folks in the audience the opportunity to ask any questions that you might have about what we've been talking about here. Maybe share some of your own individual challenges. We want to make sure that you get your questions answered. So, are there any questions in the audience about what we've been talking about? No questions? All right. Well, with that, I would like to thank you for joining us, Mike. Thank you very much for an interesting dialogue.
Thanks, Jim. I enjoyed that.
And for all of you in the audience, obviously, if you need to reach us, here's how to do so. Enjoy the rest of the conference, and thanks again for coming.